All right, everyone. So it's been just over a half year since I shared my dividend stock portfolio, and I'm going to share it again in today's video. So I own 41 dividend paying stocks. I'm going to share a link in the description below. If you follow that link, you can download my dividend stock portfolio and follow along today's video at home. Now, if you already downloaded my dividend stock portfolio previously, you do not need to sign up again. There should already be an email in your inbox with my updated dividend stock portfolio. A lot has changed since I last shared my dividend stock portfolio. The most important metric, or one of the most interesting metrics to me, was dividend cash flow. My cash flow from dividends just over this past 7 months, it has increased by 7.5%. And so I'm going to talk about that metric a little bit more. And I'm going to share some other metrics in today's video that are actually not even available in the dividend stock portfolio that you have in your hands. And so I'm going to share a lot of interesting stuff in this video that complements the dividend stock portfolio. So it's sure to be an exciting video today. Let's get started. All right, everyone. So, like I said, I shared last in December of 2018. So it's been just, over half a year since then. Since then, there have been some really big changes in my dividend stock portfolio. I want to go through those first. First and foremost, there are two new stocks that I added. I added Chubb and I added ABBV. If you want to learn more about those new positions, I'll link in the description below. I did separate videos about each of them. And so Chubb and ABBV. Now, here is something that just fascinated me. The value. This is not in your dividend stock portfolio at home, the one you downloaded, because I don't share the value publicly. This is something personal to me. I don't feel comfortable sharing that on the internet. I share so much. That's one thing that I don't feel comfortable sharing. But I have it in my version of the portfolio, obviously, and I compare it over time, and the value, just the aggregate value, the dollar value of my portfolio, just over this half-year period, it has increased by 21%. And so this is a function of new capital deployed. This is a function, though, more often than not, of the stock market just going up. The stock market has gone up and to the right. A lot of the stocks that I own are trading at very high valuations. We'll get to that in a minute. And it's really nice for my ego. Like when I did the portfolio value and I saw that value, I was like, whoa, that's really good, Ian. Nice work. In just half a year's time, it's up 21%. But at the same time, that's not my goal. I can't pay the bills with portfolio value. I mean, some people do. They sell stock and they do that. That's just not a sustainable strategy, however, for the dividend investor and for anyone, quite frankly, in my opinion, looking to live off of cash flow over the very long term. I'm talking, 30, 50 years or more. It's just not sustainable, in my opinion, to sell off stock to pay bills. And so it's surely nice that the value is up 21%, the dollar value of my portfolio. I love it. But at the same time, it's kind of bittersweet because it means that the stock market, the stocks are at higher valuations, which means they're more expensive. So it's harder for me now to reach my cash flow goals because the higher the stock prices, the lower the starting yield. We'll get more to that in a minute. And so it's kind of bittersweet, but honestly, it definitely feeds the ego when I see the value up that much. And I'm kind of just shocked. It's up so much over that just half year period. So the current dividend yield, just if I take all of my dividends, all of my dividend cash flow, and I divide by the portfolio value, I get, what's my yield? What's my yield if I were just to go out right now and replicate the same portfolio, start from scratch today? I'm not talking about yield on cost. I'm just talking about starting yield, current yield. And so the current yield last time when I did this analysis was a 3.89%. This time it's down to 3.45. And so this backs up my last point. Why is my starting yield, my current yield, down? The reason it's down is, quite frankly, because the stocks have gone up. The stocks have gone up. I haven't done any wild reallocations of my assets. I haven't sold stocks and bought stocks. I have, added 2 net new stocks, but they're very small allocations at this point. And surely I've been adding more money, but look, it's nothing that's so huge that it's going to rock the boat one way or another. Quite frankly, I've been adding a lot of money to high yielding stocks. And so if anything, it should bolster the starting yield, the current yield of my portfolio. The reason that this is down is because the stock market has just gone up. This is an indication of what I was just saying. When the stock market goes up, oh, it's so nice to see my portfolio value up 21%. Thug life. But that portfolio value going up, it means that I'm able to buy less value now with dollars that I'm investing right now. And dollars both that I'm reinvesting, dividends being reinvested, but also net new cash that I'm deploying to the market. So again, it's bittersweet. It's a bittersweet story here, but it's all good. Now, this is my crowning achievement. I am so proud of this. The cash flow, the actual cash that I'm generating for my dividend portfolio, it's up 7.5%. when I compare the last update versus this one. Again, these metrics aren't in the portfolio that you downloaded. These are metrics I don't feel comfortable sharing, the raw dollars that I have deployed, the raw dollars I'm getting in cash flow. But I did these percentages behind the scenes because I want to share value in today's video, stuff that is not even available in the portfolio that you downloaded. But again, this is progress. This is the power of small ongoing purchases. I haven't done any major purchases, but what I've been really good at is reinvesting dividends. I've been really good at deploying new cash diligently, methodically, several times per month for the last 6 months. And by doing that, my dividend income has increased. And I'll tell you, the other factor is a lot of the companies I own have increased their dividends. So it's this compounding effect. This is why dividend growth investing works. Put another way, you probably work a job. I work a job. Most people watching this channel work a job. Over a 6-month period, how many of the people out there are getting a 7.5% increase in salary? Over a 1-year period, this would be about 15%. How many people watching this video in the community are getting regularly 15% more income per year from a job? Some people are doing it. I've been in situations where I've done better than that. But what I'm saying, on average, for most people out there, for most of America, for most of the world, 15% annualized increases in salary over the long run, that's really difficult. And so what I'm saying is this right here is the power of dividend investing. And this is dividends working for me, going out there, working so hard, providing cash flow that I can use to pay the bills. And this cash flow is literally up 7.5% over the last 6 months just because of net cash invested, because of reinvestment, and because of companies raising dividends. Those are the 3 levers, and they're working in my favor. So really excited about that. So moving on, I have some new metrics. So as you're at home looking at the spreadsheet, again, I'll link in the description below so you can download it. But like I said, if you're already on my mailing list, you already downloaded it before, you'll get it. You already have it in your inbox. I added new metrics this time to the spreadsheet. I wanted to make it more interesting. I want to improve each time. And so one of the things is I added a PE ratio, a 2019 forward PE ratio. What is the PE ratio forward looking for each of the companies, each of the 41 positions in the portfolio? I break that down this time, and I also have a weighted average at the bottom. The weighted average literally weights by my position size, by my allocation to each position. And the weighted average right now, forward PE, is a 20.59. This is another way of explaining this, the current yield being down, my portfolio value being way up. This is an expensive stock market. Stocks are going up, starting yields are going down, PE ratios are going up. At an average PE here, weighted average of a 20.59, that's a real expensive market. And what it tells me is, hey, Ian, don't get too comfy with your portfolio value here. Don't let it affect your ego too much. Get comfy with your dividend cash flow, because that's what matters. That's why you invest. That's what you'll use to pay bills. That's what you're already using to pay the bills. Thug life. But don't get too comfy with that portfolio value, because based on these PE ratios, the market's probably going to correct at some point. Now, the Fed is doing everything they can do to prop up the market with talks of interest rate cuts. So we'll see what happens there. But I'm talking over the next few years, there's probably going to be a pretty big correction at some point, just based on these crazy valuations. And so something to be ready for. But look, I'm looking forward to that. If the market goes down, my starting yields, my current yields will go up, which means is when I buy stocks, I get closer to financial freedom quicker. So what else? I included a column now for market capitalization. I show you the market cap of each of my positions, and I show a weighted average as well, again, weighted by position size. And my weighted average market cap is 137 billion. So what it really shows is I own bigger companies. But what it also shows, again, is all of these companies, they're getting bigger. These assets are getting lifted in their value. I was just shocked that my weighted average was so high. And one nugget of information that gave me is, hey, Ian, maybe I ought to be looking at some of the smaller companies in my portfolio, those smaller by market cap, seeing if there's some opportunity with those to add to those positions. So that was an insight that just helps me manage my portfolio a little bit better. So moving on, I already shared this. I'll link in the description below. I just did a video. I go through the 10 Ks of all of my companies, and I pull out US versus international in terms of revenue, in terms of sales. And some cases it wasn't US, it was US plus Canada, North America. And so it's a proxy of what my domestic versus international exposure is. And overall it comes out to 58% US, 42% international. And so that's a new metric I'm sharing. International diversification by revenue is really important to me. If you want to learn more about that, I link in the description below to a video about that. And so check it out. But the insight this gave me is, hey, Ian, I'm doing pretty well on my international diversification. I'm pretty good there. Not a concern. And so these first two, these metrics gave me more of an action. The PE told me, hey, Ian, be a little cautious here. Don't get too comfy with your portfolio value. It's going to go down. Market's way overvalued. This one, the market cap, told me, Ian, maybe start looking at some smaller companies as well, because you are skewed towards pretty big, large cap companies. Okay, so I want to go through also. Oh, here's another column. I talk about allocation this time, and I talk about my allocation. I show you my percentage allocation by stock, and that's how much money I have in each stock as a percentage of the total. But what I also did this time, this was a subscriber suggestion, is I looked at allocation by cash flow, by dividends. Because some companies, even though there may be smaller allocation in my portfolio by dollar amount, they pay disproportionate dividend income because their dividend yield's really big. And so what I also show is my allocation by dividends and my concentration of dividends amongst the companies. And one of the takeaways, we'll get to this later, is SIN stocks. Wow, huge percentage, huge allocation of dividends. And it's just another reason why I need to continue to diversify my portfolio and not be too reliant on SIN stocks. We'll get to that later. But check out those columns, new columns. Spreadsheet this time is better than ever. It's really cool. I hope you guys like it at home. Please, if you do like it, subscribe, comment, put comments below what you think of it. All that means the world to me. All right, moving on. So some interesting stats. Here we go. SIN stocks. My allocation to SIN stocks is 10.88%. That's how much of my money I have in the SIN stocks. But in terms of contribution of cash flow, SIN stocks contribute 19.85% of cash flow. So it just goes to show I'm using my portfolio to live off of dividends. I don't care really about dollar amount of the portfolio. I don't really care about how much money I have, although it feeds the ego when it's up this much. But what I do care is paying the bills with dividends. And if 1/5 of my bills roughly are now going to be paid by SIN stocks, that's a pretty big allocation, pretty big concentration. So it's a reminder to me, hey, over time, I need to wind down that position a little more. And I'm not going to do it by selling. What I'm going to do is I'm going to do it by consciously deploying money to everything else. That being said, and also probably stop reinvesting in SIN stocks at some point, but I got to reinvest now because the value there is so tremendous. All right, another interesting stat. Consumer packaged goods plus consumer packaged goods food plus SIN stocks. Kind of all these consumer packaged goods types companies, they make up 43% of my dollar allocation, 46.5% of my cash flow. And so that just goes to show I am so concentrated not only on SIN stocks, but the CPG category as a whole. And so I just need to be really careful going forward. Is that what I still want? It is. I really like that category, but it's something that I just need to be cognizant of, that I also need exposure to other categories, and I just need to be careful there because I'm pretty darn heavy in CPG. So, and by contrast, industrials, my current allocation is only 7%, and my goal for industrials is 11%. And so what this tells me is companies like 3M, I got to keep putting money into companies like 3M because I want to even out the allocation just a little bit. And I want to do that instead of putting too much more money into sin stocks and other CPG companies like Unilever, because I have a lot of money in those already. And so 73% of my dividends right now are being reinvested. The other 27% I'm starting to use to pay bills. I'll link in the description below. I just did a video on that. Don't worry, I'm still also deploying net new cash to the portfolio. If you want to see which stocks in particular I'm reinvesting, which I'm not, I have that in the spreadsheet. By the way, I'm still deploying net new cash because my income level, it can be a little bit lumpy. It's not the same each month. It's lumpy throughout the course of the year. And so the reason I decided not to reinvest some of my dividends, I'm taking 27% as cash to pay bills, is I want a baseline budget throughout the year that works. And then in those months when I'm making more money, I'm just going to take that extra money, deploy it into the market in terms of stock purchases, take all that gravy, get it working for me. But that's why some people were asking, Ian, why do you instead of doing this, just reinvest it all and don't put more money in the market? That doesn't really work for me because, again, I'm trying to build a baseline budget that works each month, all of the months. And like I said, when I have net new cash to deploy to the market, sometimes it's a bit more lumpy. And so it just makes me, it's a tool that I can use to manage my finances better. And quite frankly, it's a tool I can use to get more comfortable spending dividends, because the whole goal here is to spend all of the dividends, use all the dividends to pay my bills. And it was a little hard taking this 27%, using it to start paying dividends. And so I want to do that to get more comfortable with it as well. So there's kind of a twofold benefit there of going that route, but that's why I'm doing it. Want to learn more about that? I have a whole video on it in the description below. Check that out. So here's a company ranking. Last thing. This is interesting. So I just look, what are my top 5? And this is ranking by money, just money in the company. I have 7.2% in Johnson & Johnson as my number 1. My number 2 is Hawaiian Electric. Believe it or not, HE at a 5.53. Number 3, Pepsi, 5.16. Number 4, McDonald's, 5.11. Number 5, Procter & Gamble, 4.73. So number 1, number 3, 4, and 5, numbers 3, 4, 5, those make sense to me. These are all companies that I would expect in my top ranks, more or less. Hawaiian Electric, this surprised me. I didn't realize I had so much money in it. And this just goes to show, I went heavy on Hawaiian Electric when it was real cheap, and the company, for whatever reason, it's just skyrocketed. This is an instance of just how dividend investing, sometimes the portfolio can get out of whack. Now, I'm not going to sell Hawaiian Electric. I'm not going to... it's just not in the cards for me. I don't sell stock. But one thing I am doing with Hawaiian Electric is I'm taking the dividends, and it's part of the 27%. And so that's how I'm looking at Hawaiian Electric here. By not reinvesting dividends, by using them to pay the bills, eventually it will go down in size. I'm not going to add more money to it. I'm going to add more money to everything else. Eventually it'll all even out. But at this kind of allocation, it's going to take a long time to do so. And that was just another takeaway. How, despite one's best intentions of asset allocation, sometimes a stock can get out of whack. Most people would just sell it to bring down the size. I don't do that. I don't sell. And so for me, it's going to be slower. It's going to take time, but I will get it back into balance over time by not reinvesting dividends and not adding more cash to HE. And I imagine it's kind of overvalued at this point. It's going to come back down anyways. And so it might just be a temporary thing as well. So thank you everyone for watching the video today. I hope you enjoy downloading my portfolio. I put a lot of work into it. I hope it's of interest to you out there. Please leave a comment below if you appreciate the portfolio, what you think of the portfolio. I love the comments, the feedback. All of that means the world to me. By the way, if you want to see my stock trades in real time, I'm sharing them on Twitter. So check out my Twitter. I'll link in the description below. Before we leave today, I got to do a full disclosure. I am long the stocks mentioned today. I am long. I own Unilever, ticker symbol UL, 3M, ticker symbol MMM, Chubb, ticker symbol CB, ABBV, ticker symbol ABBV. I own Johnson & Johnson, ticker symbol J&J, Hawaiian Electric, ticker HE, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, and Procter & Gamble, ticker symbol PG. I own all of those in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Just sharing my personal journey here on YouTube for your fun and entertainment. Hey, we're 30,000 dividend investors strong here in this PPC Ian community. You are invited to join the community today. It's as simple as subscribing, clicking that little notification bell so you're alerted of all the new videos, and join the discussion. This is YouTube's dividend investing community. I love you all. I'm blessed. I'm so thankful to have this community. It is amazing. And I will see you all in the next dividend investing video.